I'm joined by Paul Donovan. He's Deputy Head of Global Economics at UBS. Paul, great to have you here. Thanks for taking a seat on our desk here.
No problem.
Portugal, does it stop with Portugal?
Well, sort of, a bit. I mean, as in the idea of these mass bailouts and the huge fiscal issues, that probably does stop with Portugal, and hopefully they'll adjust the debt on Ireland a bit, and we've still got a Greek restructuring to get through, but basically that's it. We know where we are. But it doesn't stop the Eurozone problems, that we've still got the Caja problem in Spain, as we've just been hearing. We've still got a number of other European governments who are in quite stressed fiscal positions. If we look ahead, we've obviously got the candidates like Italy and Belgium with very high levels of debt, but we've also got countries like France where the debt dynamic is not terribly good. The deficit is rising very rapidly. And whilst these are not likely to have crises in the way that, say, Portugal or Ireland have had a crisis, they are still vulnerable to market pressures as we go forwards.
And with regards to the one-size-fits-all approach to monetary policy for all of these countries with these very different problems, that's a danger. I mean, what do you think of the prospective rate rises that we're expected to get from the ECB?
Well, whatever the ECB does, it's guaranteed to be wrong, because you've got at the moment, in nominal terms, you've Germany growing 4.5%, Greece growing -6, -6.5%. How can you have a single interest rate for those two countries, which is appropriate? So whatever they do, it's bound to be wrong. What they're doing, of course, is setting monetary policy for the benefit of Germany and just saying to the rest of Europe, tough, you deal with it. That's one approach. It's not necessarily one which is going to help these countries as they struggle to overcome their debt problems.
Let's talk about the US for a moment, because the IMF, it was warning about growth in the US and Japan on the back of higher oil prices. First of all, is that a concern for you? Are you concerned about global growth?
Global growth, no. Because what's happening with the oil price increase is we're taking money away from oil consumers, we're giving it to oil producers. But what's happening at the moment as a result of what's been going on in political terms in the Middle East region is that oil producers are then spending that money again on imported goods. So the money is going back round again.
Right, so we still get global growth. But
Yep.
With regard to the US, this is a huge tax on the consumer there.
Now, the US is a different case, because if we look at somebody like Germany, Germany's paying more for its oil, but it's selling all of those BMWs to the Middle East. If we look at the United States, they're paying more for their oil, and really people don't buy American-made goods anymore, certainly not in the Middle East. So they're not getting the export benefit. So it is a drag on US growth. It's not as bad as it has been, say, in the past. This isn't 1974, but it is a drag on US growth.
Now, the latest warning from the IMF is a rebuke to the US, saying that it lacks credibility, a credible strategy to reduce its public debt, and that could pose a significant threat to the global economy. The U.S. has some problems in this respect. I mean, they're about to reach their debt ceiling and force a shutdown in Congress.
They certainly do have problems. I mean, I think the debt ceiling issue will be resolved. That's not normally a problem. There's a lot of posturing, but it'll eventually be resolved. They're right. There isn't a credible strategy. I mean, the United States needs to raise taxes and cut spending to get its deficit under a sustainable position in the medium term. And that's really a two-president problem. One presidency is not going to do this, in my view. It's going to take two separate presidents to get that strategy fully implemented. It's going to take time to get the debt and the deficit under control. On the other hand, bear in mind that the US debt level as a debt-GDP ratio is still below that of nearly every European country, certainly every Eurozone country. And that's a mitigating factor. It gives the US some time. Doesn't mean they can shy away from the problem in the long term, but it means that there's perhaps a little less urgency about it.
Right. Paul Donovan, UBS, thanks very much for being with us. Come back again soon.